All right, ladies and gentlemen, I'm going to pop open a disclaimer here in just a second. And we're going to make sure everything's rolling good on YouTube. All right, Tanya, where should I be seeing this?
Should be up in a little bit. Okay, it's up.
So if I have that, it'll pop up on my, on the main page?
Should be on the main page. I'm checking right now.
Okay.
Okay, it's up.
I'm going to share my screen and you're going to tell me where it's at. Teaching an old dog new tricks here, my man. All right, help me out, brother. Let's see, right here. That is the page, no?
Okay, yes. Do you want me to send you the link for it?
Yeah, send me the direct link.
I
I can make sure. Oh, never mind. I see it. I see it.
Okay, yes. Do you want me to send you the link for it?
No, I found it. Yeah, send me the direct link. I found it. I can make sure. Oh, never mind. I see it. I see it. All right, friends. We're just getting our kinks worked out here. There's everybody. There's the chat window. All right. What's going on, friends? Got some bear market tactics on the agenda for tonight. I'm going to give it just a minute, chit chat for a second, see if we get our friends to join us here. And then we will rock and roll. Okay, we'll walk and roll. Got Gregory in the house. Hello, Gregory. Thiago, Whitney. Hello, hello. I'm going to be taking some notes tonight. So let me pull open a doc there. And let me also get the disclaimer going. Frank's in the house. What's up, Frank? Okay, there we have it, friends. Got the disclaimer taken care of. Let's chat about these bear markets we're dealing with right now. Last week, who was here last week? Coach Noah talked about the bear retracement pattern. Thought we'd do a follow-up today, also focusing on bear markets, but wanted to focus specifically on different trading tactics and trading tips for how to weather a bear market. So really excited about the content tonight. Take some good notes for you. See if I can upload this on probably the Taco Trading website over there. So if you want tonight's notes, we'll make sure you can get access to those over at tacotrading.com. So let's hop to it. All right. I've got 6 bear market trading tactics that I want to focus on. I also want this to be an engaging, enlightening discussion. So don't be shy. If you want to use the chat window, you can throw your comments there. It's on the right-hand side of my screen, but don't be shy as we go through here. It'll make me feel like I'm not alone. It'll make me feel like I'm not alone. All right. So first things first, I want to talk about some definitions for a second. And I lost my cheat sheet. I need my cheat sheet here. Come on. Coming up, coming up. That'll make this run smoothly if I get this bad boy up. Okay, so first little pop quiz question here. What is a bear market? How would you define a bear market? How would you define a bear market? Got to know the definition in order to follow along with the conversation. No takers, or maybe there's a delay. Oh, Fortino, attaboy. So the Wall Street definition is a 20% drop from the peak. Okay, 20% drop from the peak. And so by that measure, we were in a bear market, a couple of weeks ago, right? A couple of weeks ago. So the way you do the math here real quick, and then I'll explain how I would define a bear market. The S&P 500 peaked at 339.08, 339.08, okay? And you take that times 0.8. You take the high times 0.8. And you hit enter, and it's 271.26, 271.26, okay? So once we dropped to 271.26, that happened essentially on March 11th, on March 11th. All right, so on March 11th, you would have seen the news media, CNBC, Market Watch, whoever follows the stock market, they would have said, hey, this correction has officially turned into a bear market. It's officially turned into a bear market. And it got a lot worse, right? I think from peak to trough, we dropped like 35%. Okay, so by that definition, you would say we're in a bear market. And Matt, thanks for the heads up. Just so you guys know, I am a newbie. When it comes to YouTube. All right. So feel free to throw tomatoes and make fun of me if you'd like. I am happy to make a fool of myself at your expense when it comes to the technology. But I told Tanya, and he's teaching an old dog new tricks tonight. So if it is a little bit blurry or there is a delay, my apologies, but we're going to make it fun regardless. All right. Okay, so as traders, we don't care about the 20% definition. Okay, we don't really care about the 20% definition because it's silly. I mean, are you not bearish if we're down 19%, but you're bearish? You are bearish if you're down 20. Drawing a line in the sand where you go from bullish to bearish is not really practical from a trading perspective. So I'm going to teach you the definition and the usage that I think is better for traders. Okay, that I think is better for traders. And that is to focus on the trend. Focus on the trend. So as a trend follower, we would say when the market's in an uptrend, we're bullish. When the market's in a downtrend, we are bearish. Okay, can we all agree with that? Like, I don't really care if the market's down 5% or down 10% or down 15%. When the trend goes from up to down, to me, that would be a quote unquote bear market because my bias turns from bullish to bearish. Okay, so I get the whole 20% threshold definition. You got to draw a line in the sand somewhere. But from a trading perspective, trend is a much better, I think, indicator of whether you want to be bullish or bearish. Okay, so let's look for a simple, easy way of defining trend. Okay, so I have a question and I'll give you time to answer this time now that I know there's a delay. Okay, and for those of you where the screen is blurry, your fellow watchers here are giving you some tips on how to modify the screen so you can see it better. It's pretty clear on my end. I can see it pretty well. So question here, when you read books about a city, usually they talk about how there's something separating maybe the north side of the city from the south side. What is it that runs through the city that often will, this is like the classic story that will differentiate between the good area where you want to live and then where the gangsters live, right? Maybe where the well-to-do people, the good citizens live, and then where, again, the hoodlums live. Could be a river separating the city. I'm thinking of something else besides the river. Tracks. I think the tracks. Do you live on the north side of the train tracks or do you live on the south side of the train tracks, right? So if you picture the stock market as a city, we would want to know, where are the tracks? Like, where's that separating line between where good things happen and where bad things happen, right? And I think a really good indicator is the 50-day moving average. Yeah, bad things happen on the wrong side of the tracks. Okay. So if I go to my chart here, the S&P 500, I'm going to take off my other moving averages so we can just be very simple and straightforward here. And I've got a 50-day moving average. Got a 50-day moving average here. Okay. And it's interesting, if you look back over a few years, when the price is above the 50-day moving average, good things happen. The path of least resistance is higher. We're in an uptrend. Okay. This is where the well-behaved, good citizens live in the city. You get to the south side of the tracks and bad things happen. Okay. Murders, commonplace. This is where you see epic volatility. This is where you see really bad price action, nasty downturns below the 50 MA. Okay. And so if you just had a little light kind of going on in your brain, when we're above the 50, I've got like a flashing green light reminding me that we're bullish. We're in a bull market. We're in an uptrend. When I get below that 50-day moving average, that red light starts to flash. Okay. I feel nervous, like I'm going to get shot, and bad things happen. Okay. So if you go back, you'll notice it's not perfect. Sometimes you go to the south side of the tracks and everything's okay. You know, you don't get mugged, but more often than not, you do. And this go around, we broke the 50-day moving average back on the 24th of February, and we hadn't broken it since September. Okay. Now you wouldn't have known it was going to get this bad. You never really know how bad it's going to get or how long it's going to last, but you know you're on the wrong side of the tracks. Okay. So let me ask you this. If I'm using this 50 MA as my line in the sand, what do you think I want to see in the stock market to get more comfortable, to get more bullish, to be more confident in declaring that the bear market is over? Do I want to see a couple of up days? Do I want to see a higher pivot low? Or do I just want to see us get back above that 50-day moving average? The answer is really all of the above, but at a minimum, I want to get back above the 50-day. Okay. So I am encouraged by the recent price action. We have turned the short-term trend, but that 50 MA is a good indication of the intermediate term trend, and that has not turned higher yet. There's still work to be done. There is still work to be done. Okay. So just a little tip. If you want an easy line in the sand, I think the 50 MA is a good level. By that metric, I would not say we're out of the bear market. Okay. I would not say we're out of the bear market. And that's true on other indexes as well. If you look at the Dow Jones Industrial Average is still well below the 50-day. If you look at small caps, the Russell 2000 index, that is also well below the 50-day moving average. And I think of the big three indexes, the NASDAQ looks the best, but it's still not back above the 50. Okay. Still not back above the 50. So I just like it because the simplicity, a nice line in the sand. It's the tracks in the city of stocks here. All right. So while we're in a bear market, I want to talk about six bear market tactics. Okay. When I mentor people, I usually say these are the things that I would consider changing about my trading when we're below the 50-day moving average. So what do I do different when S&P is south of the 50-day moving average? South of the 50-day moving average. Okay. So number one, if in doubt, stay out. Okay. Park yourself on the sidelines. This isn't going to last forever. Okay. As they say, this too shall pass. But what happens if you are so stubborn that you just keep trading, and you get the snot kicked out of you and you lose a ton of money, or you just don't do that well? Don't you think like 2 months from now, if the market returns to normal and you've lost a bunch of money, that you'll look back and say, you know what, maybe I would have been better off just kind of hanging out and not going through so much drama. So there are certainly ways that you can participate, but let's not kid ourselves. Volatility like this, by the way, this has been an unprecedented bear market as well. March was the most volatile month we have on record. It's never been that volatile. So it's not as if this is an easy environment with this type of epic volatility. I wouldn't be ashamed at all of saying, I want to participate when the market's favorable to my trading. This is not favorable to my trading. Therefore, I'm going to park myself on the sidelines for a little bit, preserve my capital. You know, you have financial capital. Here's something I want you to think about. You have financial capital, okay, and you have a finite amount of that. Let's say you have, I don't know, whatever it is, doesn't matter, 25,000 in your account. But you also have emotional capital. And you have a finite amount of emotional capital, okay? If you burn through that by getting chopped up in the market and trying to force trades when things are messy versus just hanging out, by the time we get through this, you're going to be so shell-shocked that even though there are great opportunities, you don't even want to pull the trigger anymore, okay? So don't feel like you have to trade. Not trading and not losing is superior to trading and losing a bunch of money. Okay, so I think that is sound advice. All right, sound advice. Number two, let's say you're like, all right, Tyler, we get it. You've said now stay out if you're not comfortable, but we want to play. We want to play. All right, well, look, you don't have to make big bets here. Can you just stay small? Can you reduce your position sizing? Reduce your sizing? Maybe instead of risking 1% of your account per trade, maybe that's your normal rule. Maybe you start risking 0.5% per trade. Okay. And so maybe we focus on minimizing regret. I'll call it regret minimization over profit maximization. Okay. Minimizing regret when the market's crazy, I think emotionally is much more important than trying to maximize profits. Okay. And so maybe you participate, but if you discover that this environment is not conducive to whatever your trading strategy is, just trade smaller. You don't have to sit out. You can play, but maybe play smaller as an acknowledgement that conditions are more challenging for whatever your trading style is. Okay. Now, if you say, well, Tyler, I'm killing it in this market. I love this type of market. This is perfect for my trading style. Well, then forget all of this. Just keep doing what you're doing, right? I'm kind of operating under the assumption that most people don't like when the stock market is the most volatile it's ever been, like ever. Okay. More than 2008, more than 1929 and the Great Depression. Like this is pretty historic. And so let's not kid ourselves. It's not as easy as it usually is if you don't like volatility. Okay. All right. Number three, here's another, I think, very, very smart tactic. And this kind of goes hand in hand with regret minimization. Okay. How many of you have noticed that you're making money one day and then the next day you're losing money? Like profits today are gone tomorrow. Particularly with the market going up and then down and then up and then down. You know, you did a bear trade off of this bear retracement. You were probably making money because the market rolled over and then it went right back up. I have had many, 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 many instances where making money one day, you give it back the next day. Okay. Go for a bigger profit, but then they take the profit that you had away because you overstayed your welcome. Okay. And then you're like, oh man, I should have took it off yesterday. Should have taken it off yesterday. But it's hard because you have fear and you have greed and you want to participate. Okay. And it's like, well, it started to move in the right direction, but we could go down another 5 or 6 days. Maybe I should keep the bear trade on. I think a much easier way to do this is to scale out. Okay. Take partial profits. Give yourself multiple chances to exit at the right time. So if you sell all at once, it's kind of like you're playing baseball and it's one strike and you're out. Okay. You have one chance. You entered a bull trade and let's say you exited it 2 days ago and then ended up market went higher. You're like, oh man, I should have waited. Right? Well, you're playing baseball and it's one strike and you're out. If you scale out where you sell half, and then later you sell another half, it's like 2 strikes and you're out. You have 2 chances to get out maybe at an optimal time. Okay. Some people will maybe have enough contracts or shares where they can sell a third and a third and a third. So then it's 3 strikes and you're out. Okay. And so you have multiple chances. You have multiple chances to try to maximize your gain. But also in case the market moves in your favor and then moves against you very rapidly, you can at least lock in some profit to use that to your advantage. Okay. So I love the idea of scaling out. Okay. I love the idea of any tactic which assumes that I'm going to be wrong and then tries to use that to my advantage a little bit, I think is smart. Okay. I think is smart. So scale out, okay? Scale out, take partial profits, particularly because it makes it easier to let maybe the rest of your position ride. Okay, so for those of you that know Gino, one of our wonderful coaches, who's a whiz when it comes to making adjustments and everything, I've heard him talk about this tactic a lot, where he'll enter his trade, and then if the stock moves, one day in the right direction, or maybe one ATR in the right direction, he'll try to close some, take some profits. And if those pay for his remaining contracts, he can basically let the rest ride. And he's taken off his original risk capital. Like he can't lose any of his original risk. Okay. So I love the idea. Okay. I love the idea there. All right. So the headline there, profits today, gone tomorrow, would kind of be what we're trying to avoid. Okay. Avoid. All right, number four. And I know you guys are throwing some questions in here. I'm going to have plenty of time to take those questions. I kind of want to spit out these tactics, and then as we let them digest a little bit, we can further investigate what it would look like. Maybe I'll show you some examples, stuff like that. Okay. All right, so number four, what else do I think is smart in a volatile type of market like this? This is one you've probably heard us say before. Day trade. Okay. You can avoid the overnight gaps altogether by not holding overnight. How many feel like that is probably the one thing that you could point to describe how challenging the market is? That one day the market is up 5%. You come back tomorrow morning, and it's not that it's down, but it opens lower by 3%. And then the next day it opens higher by 4%. And it's kind of like robbing you of the ideal entry because it's gapping so much. Okay. It can be frustrating. Now, maybe you like that. Okay. I don't know many people who like that because it's challenging because you're not able to get in and out at the price you want. And so the benefit of day trading, when you think about this, is you get to use the big volatility to your advantage. I mean, I don't know if you've been paying attention, but if you look at the ATR for I'm going to big numbers, so I'm going to use the index. SPX, the ATR is like $125, $125. It's insane. Okay. Day traders need movement. And I mean, they're getting as much movement as they can really handle right now. It's like, you want movement? Well, come join us right now trading. The market's moving like crazy. And so the volatility is great intraday. If you had a bunch of doji candles, a bunch of little narrow candles, day trading on a day like that, there's not much to do. But you get these massive candles, there's a lot of potential opportunity. Okay. And you're done by the end of the day. Like you're not holding overnight. People who day trade The market opens 9:30 a.m. to 4 p.m. Eastern. If they're day trading stock, that's the regular trading hours. And they're done. They're done by 4. They're out. It doesn't matter if the market gaps up 7% tomorrow or down 30%. 30%. No, it's not going to gap down that much, but it doesn't matter because they're out by the end of the day. Okay. So if ever there was a time to explore the merits of day trading, I think this is a perfect environment. Okay. I think this is a perfect environment. So that's number 4. Okay. That's number 4. We got 2 more. Number five. And by the way, do you think that each one of these could be a discussion, a webinar in and of itself? I mean, if in doubt, stay out. We could spend this whole hour talking about how to play golf and what we want to do while we're out of the markets. Reducing your sizing. Actually, some of these are probably pretty straightforward. Some of them I think I could talk quite a bit on. All right. But I want to get you thinking tonight as to other areas you can explore, because I don't think that this bear market's going to be one and done. I hope it is. I hope that we're right back up. But I'd be surprised. I'd be surprised if we immediately go back to the highs. Okay. All right. Number 5. If I'm going to do a directional trade, if I'm going to do some directional trading, okay, I want to use low cost spreads. For directional trading, I want to use low cost spreads. Okay. Because then I don't need a stop loss. Okay. How many have been whipped out of trades over the last couple of weeks? You enter a trade, goes against you, you take the loss, and then it moves back in the right direction. That can be frustrating. Knowing where to put your stop loss when the market's really volatile can be challenging. Well, what if you could build a trade where the trade costs $100 or $150, and you're comfortable with that? And that's the maximum loss where you could put the trade on, and then doesn't really matter what happens. Worst case, you lose the $100, $150. So one of the wonderful things about option spreads is when you do things like for bears, if you do like an out of the money bear put, or maybe a put butterfly, they're cheap. They're really cheap. And they give you the flexibility of just kind of letting it ride, and you don't need a stop loss. Okay. If you're going bullish, there are cheap bull trades you can do. Out of the money bull call is probably the one I would focus on. But you can structure them cheap enough to where you just let it ride. Okay. So it's like, okay, if you want to make a directional bet on Zoom that it's going to recover, or if you want to bet that the S&P is going to roll over in the next couple of months, you don't need to short it with a tight stop, or short it and then wonder, where do I put the stop, or buy a super expensive put and have to use a stop loss because you can't afford the risk. Just build a cheap spread with the amount of cost or risk you're comfortable with, and let it ride. Okay. I would do that over obsessing about, man, where am I going to put the stop loss? Am I going to get shaken out? I wouldn't worry as much about that. Okay. Number six, let's trade volatility versus direction. Okay. So let's basically say I have no idea if the market's going to go up or down in the next couple of weeks. I just don't think we're going to go up to 3,200 by May. Or I just don't think we're going to go down to 2,000 by May. Or I think the market's just not going to move that much, or that it's going to move a lot. And so you could basically bet the market will move a lot via bi-directional trades. Or you could just bet the market will settle down and not go, way up or way down. And so you're essentially making a bet on volatility, which might be a little bit easier in your mind than trying to guess if the S&P is going to go down again, if it's going to keep ripping. Maybe you find that day to day, hey, pick a direction and guess which way you want to swing, exhausting. And maybe you've been, beaten back and forth with that. Well, I mean, maybe you explore other types of volatility-based trades that focus more on how much the market moves versus which direction it moves. Okay. All right. I have one or two more things to mention, and then I'm just going to open it up, and we're going to maybe look at some examples, talk through some of this, and I'll take questions for the back half. Cool. So last thing, or two more things. Okay. Stock picking, pretty much dies in a bear market. All right. So my headline there would be a bear market where stock picking goes to die. Where stock picking goes to die. Have you guys noticed that everything pretty much moves together? Everything pretty much moves together. Like today. Today was a big up day. I bet almost every stock went up today. Okay. When the market was crashing in March, pretty much everything was crashing. Pretty much everything was crashing. Yeah, every chart looks the same. So the fancy way of saying that is correlation runs to 1. Okay, correlation runs to 1. In statistics, there's an indicator called the correlation coefficient. It's a statistical measure that measures the relationship between two different things. And if they always move in the same direction, then we say they have a correlation of 1, or they have a perfect correlation, or a perfect positive correlation. If every time this guy goes down, this guy goes up, they're moving inverse. We say they have a perfect negative correlation. Okay. In a bull market, it's not a stock market. It's a market of stocks. There's a lot of differentiation in a bull market. You have the winners and the losers, the haves and the have-nots. Companies are able to differentiate themselves. Okay. We trade more on fundamentals, and you see more idiosyncratic movements going on. Things that are unique to this company or unique to that company. In a bear market, it's not that way. Okay. It's not a market of stocks. It's a stock market, as in it's moving like everything is one stock. Okay. Like everything is one stock. Okay. So because of that, you aren't rewarded as much with your stock picking. For example, do you think it mattered as much when the market was crashing which stock you were short? Or do you think you pretty much could have been short anything and probably made money? I think you could have been short pretty much anything. Okay. How about over the last couple of weeks as the market has rebounded? Has it mattered as much which stock you were long, or just the fact that you were long something? I think you could have been long just about anything and made money. Now, I am painting with a broad brush, okay? You can point out exceptions to this rule. You could say, what about Clorox? Clorox has held up okay. If I bought Clorox or Walmart or Costco, I actually would have been okay during this bear market. That's true, but for every one of those, there are 30 other ones that just moved with the market, okay? That just moved with the market. And so if I'm not being rewarded as much for picking stocks, then why obsess over it? Like if you think, look, I think this bounce is going to fizzle, right? Now, I don't necessarily think that. I would not be surprised, but let's just pretend that's your bias. And you think the market's going to roll over. I don't think that I would spend a ton of time and effort going through my watch list and looking at 100 different stocks and obsessing over, well, should I short retail or restaurants or casinos or tech or utilities? Like where, I really got to pick the right one. No, you don't. No, you don't. You can just short the entire market. Okay. So I'm always a fan of trading ETFs, but particularly so in a bear market because it just simplifies everything. Okay. So why not just trade ETFs? Okay. Why not just trade ETFs? Why not just, if you think the market's going to roll over, short the market, trade SPY or IWM or the Qs or something. If you think the market's going to recover, you could obsess over which stock to buy, but honestly, I'd rather just buy the market. Can you imagine how frustrating, by the way, it would be if you're like, I think the market's going to tank. And so you go short Apple, maybe not Apple. Let's say you go short, I don't know, Walmart, and the market plunges but the stock you shorted is the one stock that stays up. That'd be terrible luck. It's like, you gotta be kidding me. I picked the one stupid stock that didn't go down. I was right on my bet. The market did roll over, but I picked the stock that didn't. I don't want that to happen. Okay. I've had that happen. It's terrible. All right. I would just rather go short the S&P or build a bear trade on the S&P somehow, or one of the other broad market ETFs. Okay. So that's right, Noah. I mean, I know exactly what's going on. I know exactly what's going on. So, the other benefit, like the bonus, is these are super liquid. They have tight bid-ask spreads, plenty of open interest if you're trading the options, lots of volume. And that's another thing that you kind of have to worry about with individual stocks is bid-ask spreads are huge. There's more slippage. It's harder to get in and out quickly at the price you want. Okay. And so why not focus on what's the most liquid way that has the least amount of friction as you're going in and going out to try to make a bullish or bearish bet, right? You focus on those main ETFs. Okay. So that's another thing that I think is worth mentioning. The high correlation in a bear market, maybe spending a little less time on obsessing over which stock you want to buy and just trading the ETFs. Now, the exception to that, I guess, would be if you're like trying to invest for the long run and you say, hey, I think this is a good buying opportunity. I love the idea of doing fundamental analysis on individual companies. I want to come out of this bear market owning companies that I really like. Okay, sure. I mean, go bargain hunting on those. I'm more talking about as a short-term trader, obsessing over whether I want to short the S&P here or whether I want to short Google or some individual company. I don't know that I would waste as much time on that. Okay. All right. So that completes the initial tactics that I wanted to cover for tonight. So what I would love to do, I know some of you asked some questions earlier, and this is the fun part of having a live session, okay, that we get to interact here a little bit. So hit me up with some questions. Which one of these do you want me to see maybe illustrate? Okay, or are there other things you're curious about with this bear market that you want an opinion on? I got lots of opinions, okay? About half of them are right, and usually half of them are wrong. But I can spin a tale here if you're curious. All right. So I'm going to take a sip out of my pink cup and see what you guys got for me. There was a question earlier from Inglorious P, which I love the name. Do I think we're going to break resistance tomorrow? If we do, SPY could run to 288. Good question. Well, I mean, not to brag, but last night on the coaches show, Noah and I did a lovely little bull bear debate. I was the bull, he was the bear, and market went up today. So just saying, I was on the bull side yesterday, and today I'm right, and I'm going to pound the table on that. And it was a one-day thing. All it was is the market going to go up tomorrow? And I was right. All right. So market goes down tomorrow. Doesn't matter. I'm calling it a one day forecast. And got it right. Rematch tomorrow. You'll probably be right tomorrow, Noah. You'll probably be right tomorrow. Although it is kind of impressive that we popped back after yesterday's sell-off, right? No downside follow through after yesterday's whack. That was kind of impressive. I would have thought, okay, you sell into strength, maybe we go lower, but today was impressive. The hard part is, don't you guys kind of feel like we're in the middle of no man's land now? It's hard to make the case that we're super cheap because you're like 25% off the lows, right? And it's hard to make the case that this is a layup short because we're kind of strong right now. It really is tough. This is really tough for me to have a strong opinion. All right, so let me go back up here. So selection process for low cost spreads. I would say, are you talking about the stock, like which stock you would do it on, or how would you structure the trade? I need clarification on that. All right, guitar flip. How would you play volatility? Let's talk about that for a second. Okay. Let's talk about that for a second. So there are two different ways that you can build a volatility trade. So one is you bet the market's going to move more than expected. You go long volatility. And the other is you bet the market's going to move less than expected. You go short volatility. Okay. So the bi-directional types of trades where you'd be betting the market's going to move more than expected would be like a long strangle, a long straddle. I'll give you the names here. You've heard of these probably. An inverted butterfly. Okay. An inverted condor, which we usually call a debit condor or debit con. Those are the types of trades that would fall into that category. Okay. The other type, betting the market's not going to move as much as expected, that would be like an iron condor, you know, a short strangle, iron condor, a butterfly, those types of trades. Or if you want to lean slightly bull or bear, you could do like a way out of the money credit spread, something like that. You know, betting that we're not going to move as much as expected. Okay, so those are the types of strategies. So then it would just depend on which one do you want to do. Like, do you want to see what a bi-directional trade would be? Like, what's your feel here? Do you think the market's going to move a lot more than expected over the next month? Do you think it'll settle down? That would kind of be the question. Okay. All right, so bi-directional trade on the SPYs. Let's go with that one. Okay, let's go with that one. So bi-directional trade on SPY. Okay, so you guys got your taste of volatility, so you think the market's going to keep moving a lot, right? The first thing I'll say is this assumes you do not have a directional opinion. Okay, so if you have a directional opinion, I would just do a directional debit spread. So bear put if bearish, that'll do really well if the market moves down more than expected, or bull call if bullish. The bi-directional play would be I would probably, straddles are really expensive. So let's think through this though. So I'm going to pull up the S&P here, and the S&P is a little more expensive as an ETF. So hang on, my computer's going a little slow here. Come on, you can do it. There we go. All right, so I'm going to go to add simulated trade here. You say, okay, I think the market's going to move a lot between now and May. So I'm going to buy, I don't know if it's going to go up or down though. So I'll do a bullish trade and a bearish trade. See, because if you do a bull trade and a bear trade at the same time, they kind of negate each other, and it becomes bi-directional, where you could make money if it goes up, you could make money if it goes down. So S&P is at 274. So I'm going to buy a 274 put, and I'm going to buy a 274 call. Okay, and that would cost $26, $26. Now I'll teach you a little tip here. That straddle, that's a straddle, is $26. That's how much is priced in. So the market is pricing in a $26 move up or down. So if you convert that to a percentage, you would just divide it by the current price, which is 274, and hit enter. And it's about 10%. So the stock market, the baseline is a 10% move is being priced in over the next month between now and May 15th. Okay. So by buying that straddle, you're basically saying you believe we're going to move more than 15% in the next, or more than 10% in the next month. Or you could say that you think we're going to move like 10% much quicker than a month. Like I think we could move 5-10% tomorrow or this week. Because if you get a fast move up or down towards the outer, end of this straddle, you'll make money. Okay, you'll make money. But you got to put up 26 bucks. I mean, you're paying 10% of the price of the S&P 500 for this bi-directional trade. So it is expensive. It's expensive. So you say, well, how do I make it cheaper? Can I make this bi-directional trade cheaper? Sure, you could make it a strangle instead of buying an at-the-money call or an at-the-money put. Maybe you go out of the money. Maybe I go 10 points up and I buy a 284. Oops. I'm going to change this to custom. I'm going to buy a 284 call and I'll buy a 264 put. I'll buy a 264 put. So I'm going to buy a $10 out of the money call and a $10 out of the money put. That's 17 bucks. I saved $10. I saved 10 bucks. Okay, so it's cheaper. Same idea though. I need the market to go up quickly or down quickly. Okay. And then another way that you could try to reduce the cost is to sell something against the option that you bought. So you bought a 284 call. Why don't you sell a further out of the money call? You bought a 264 put. Why don't you sell a further out of the money put? So I could actually say, well, let's sell a 254 put against the 264, and let's sell a 294 call against the 284 and bring in $10, bring in 10 bucks. So now you've got what's known as a debit condor or a debicon. Okay. Multiple ways to think about this. You're long a strangle and short a further out of the money strangle, or you can think of it as you got a bull call and a bear put, same thing, but it's a bi-directional trade. So your expiration break even is about 257 and 290. So if I put lines on the chart, if we get above 290, I win. If we get below 257, I win. So this is a bi-directional trade where if we go outside of this range, you win at expiration. Something like that. Okay. So the bottom line is we can have a directional opinion. I think the stock market's going to go up or down, or we could have an opinion on how much the market's going to move, the magnitude. In this case, we thought the market was going to move more than expected and explored a long straddle. We made it cheaper by converting it to a long strangle. And then we made it even cheaper by converting it to an inverted condor or debicon. Okay. All right. So there you go. There's your volatility illustration. Okay. The next one was Paul. Low cost directional spread. So Paul, how to structure the trade. Yeah. So let's say you want to go bearish. Okay. You think that the market is up in the night and it is way, way underestimating how bad things are going to get. And you just can't believe it's rallied 25% off the lows. And you're like, look, you're delusional, Mr. S&P 500. When these earnings come in and we have to stay at home for another month, this thing's going to go back down. Okay, well, look, you could buy a put as a way of capitalizing on that. You could go out maybe a month and you could go buy like an at-the-money put. Let's start expensive here to prove my point. You could buy a put on the market. It's 13 bucks. Let's redo that. It's $13. Actually, here's what I want to do. For this put, 274. What does that mean? It means the market's got to drop 13 bucks by expiration to pay for your put. So that put is pricing in, I don't know, 5% down move. So you could do that. You just buy a put, but who wants to pay $1,300 on a put? Maybe the market skyrockets. I don't want to risk 1,300 bucks. Now I got to figure out where to put a stop loss. Knowing my luck, I'll put a stop at 285. It'll run up to 285, knock me out, and then go right back down without me. I want to avoid that. I want to avoid that. But I need a cheaper trade because 13 bucks, forget it. I'm not risking $1,300. Okay. So what am I going to do? Well, I keep going to the wrong place. I'm not only going to buy this 274 put for 13 bucks. I'm going to sell a lower strike put against it. I'm going to sell a 264 put. Okay, that's going to turn it into a bear put spread. I'm buying the 274. I'm selling the 264. I'm paying $3 instead of 13. I'm paying $3 instead of 13. When you look at the risk graph, now I've got a debit spread. Okay, this would be like an at the money bear put. Long the 274, short the 264. I'm only risking 339 bucks. I'm only risking 339 bucks. Maybe I'm comfortable with that. So now I don't need a stop loss. I can just let it ride. If the market skyrockets, I'm only out 339 bucks. Not bad. Not bad. But maybe that's still too expensive. You say, yeah, I still don't want to pay that much. We can make it cheaper. You know, visually, you bought an at the money put and you sold an out of the money put. Now, the hilarity is that 10 bucks out of the money is today's low. So like $10 wide spreads really not that wide these days. All you got to do is go below today's low a month from now and you made good money. But maybe that's too expensive. And so you say, I want to make this cheaper. Well, don't buy an at the money put then. Maybe you buy the 264 put, buy an out of the money put, and sell an even further out of the money put. So maybe I come in here and I buy the 264 and sell the 254. That only costs $2.50, $2.50 for a $10 spread. So you're risking 2.5 to make 7.5. Not bad. Okay, so you look at that on the risk graph, risking 250 to make about 750. And it's just got to get below 254 at expiration. So it's just got to be below this lower red line. Could I keep going? Could I do a 254, 244 for even less cost? Sure I could. So I could come out and go even further out of the money. It's just at some point, you don't want to make such a low probability bet that there's no chance we're going to get there. I mean, here's a $10 spread for $2. $10 spread for $2. Okay. And so what we're trying to do here is explore just the principles, and there's not one right way to do it. There's not one right way to do it. You can, here's what I wanted to do, 254, 244. You can pick whatever price you want. They're all bearish. It's just the out of the money ones are a little cheaper. So you pick the one that has the right, risk versus reward balance that you want. Okay. There are further things we could do, as Dennis is getting into. We could make it even cheaper, getting into some kind of butterfly or broken wing butterfly or something. But that's the idea. Okay. So I would start simple with just like a debit spread. And you don't have to do May. If you want to give yourself more time and go out to June or July, you could do that too. You can go out a little further in time to give yourself more time in case the market needs more time to roll over, if it rolls over. But even if it doesn't, I took a calculated limited risk bet that didn't require a stop loss. Okay. So that is an example of number five on the list here. I prefer that much better than shorting the S&P or buying a super expensive put. Okay. All right. Next, a couple more, and then we'll call it a night here. So David, I did the bi-directional. Lewis, it could. I mean, the Q4 2018 was nutso. That's essentially what we got in Feb, March. That happens again, watch out below, but obviously bear puts would make a lot of money in that environment. So Jimbo, again, you'll find the exceptions to the rule for the correlation running to 1. Just think about the stocks that are holding up right now. The grocery stores, Walmart, Zoom, a DocuSign, Teladoc, healthcare stuff. So obviously you can find stocks that are holding up. It's just harder. It's just harder, a harder way of trying to scratch out some trades by picking the few that are bucking the trend versus just going with the tide, right? Gregory, so why not buy a good company, and if it goes up, sell it. If it goes down, just buy more or hold it. You could. Yeah, you could. It's, but as we've seen, like name your good company. Anybody who's held good companies has still had to sit through probably a 30% decline, right? So it can get painful. So the key is just to size properly. I don't have any doubt whatsoever that this will turn into a long-term buying opportunity. Because bear markets are always long-term buying opportunities in hindsight. The question is, are we done? Are we going to have another down leg? Is the market just, did it so overprice this that we're going to go right back up, and everything's just fine? You would think there's aftershocks, but you just don't know. There's a lot of uncertainty. So like I said, I think the challenge, if you're trying to put money to work longer term, is that it's like, well, shoot, now I'm 25% off the lows, and I'm either forced to buy higher or I'm patient and wait and see if we go lower again. I would scale in. I think all or nothing decisions right now with buying a bunch of stocks for long-term holds that's a tough sell for me. That's a tough sell. And okay, so Uday, so for scaling out, so here's an example. All right, last question, then we'll bounce. So for scaling out, let's say that let's say I went crazy aggressive with this bear put, okay? Because I think the market's delusional. Hopefully I'm not the one who's delusional, but let's say I did this bear put, okay? 254, 244, paid $2. Paid $2, and you got an out of the money bear put here, in case we roll over in the next month. Now, we may not. I have no idea. I think this is a pretty good risk reward trade if I'm right, though. Okay. And if we go down, I am going to try to make, I don't know, $2 on the first one and take it off and let the second one ride. So I can look at the risk graph and I can model what I would need to make $2. If we drop down to 250, I'll double my money. So maybe we drop down to 250. I take one off, just sell one. You'll have two contracts, just sell one of them. However you do that, order wise, you close one and let the other one ride. You don't really have to preset it. You could, but it's not complicated. It's just, I own this many and I have a good profit and I want to sell part of them, right? Or maybe I buy 3 for $200 a piece. Once I'm up $200 on 2 of them, maybe I take those 2 off and I leave the third to let it ride. Okay. I just want to get, a quick profit, and you don't have to necessarily fully pay for the remaining one, but I just want a quick enough profit to peel it off and then let the other guys run. And whether that means you exit if we hit 255 or 265 or 245, your call. But the principle is take the gain, but give yourself a chance to make more in case this thing really rolls over. If it doesn't and it goes back up, you'll be happy you took some partial profit. It creates a potential win-win scenario. And those are always psychologically easier decisions to make. Okay. All right. Pound it, my friends. I'm going to end it here. You guys have been awesome. Appreciate you for hanging out. Come join us over at Tackle Trading. All right. If you're not already with us, maybe you're already part of the team. But if you're not, please join us and keep your heads up. We'll see what the market has in store this week. All right. Okay. We'll see you guys later. Bye-bye.